So Brandon, we've talked about life insurance for estate planning purposes, but what other ways can we use life insurance?
Life insurance is a great tool just to mitigate risk across several different aspects. Reducing debt, paying liabilities off the balance sheet, making sure that you're replacing that income for the surviving spouse, especially if that surviving spouse doesn't have an active role in that family farm or ranch operation.
So again, we've talked a little bit before. Can you talk about, again, here how the ownership structure of that should work if we're, let's say, using it for debt mitigation?
Yeah, so a lot of times, depending on who's responsible for that debt. So if the individual is responsible for that debt, then a lot of times that policy should be owned by that individual with their spouse or their estate listed as the beneficiary. So they have the liquid funds to pay off that personal debt. Now, if the debt is at the corporate level or entity level, then a lot of times that should be owned by the entity itself. So with a lot of times our operating entities, if the family farm operation has a partnership or an LLC as the operating entity, and they have maybe a significant line of credit or they have a significant debt obligation to their line of equipment, then a lot of times we'll take a look at having that policy owned at the entity level, so that tax-free death benefit comes into the entity to reduce that liability. And the positive side of that is it also frees up cash flow for the owners of the operation. The other aspect which a lot of our people don't consider when it comes to a family farm or ranch is it is a business. And with that business, a lot of times there's individuals that are really key or an integral part of that organization. So a lot of times we'll even have our family-owned businesses or farms and ranches consider key person life insurance. And key person life insurance is a policy that the entity would own to help ensure that it has enough working capital and cash flow to maintain its viability in the event that key person was lost prematurely. So a lot of our operations are large enough to where the family member may have that CEO, COO, or CFO type of personality, and they're really generating a lot of the profits associated with that family farm or ranch. And if they lost that individual prematurely, they not only lose the individual, but they may lose that knowledge base. They may lose that decision maker, and it may affect the cash flow of the operation. So a key person policy really just puts that tax-free death benefit back into the entity until a next generation or somebody else can grow into that role.